So we go to chapter 8, income elasticity of demand. So when we talk about income elasticity of demand, income itself means the amount of money an individual make over a period of time.
Yes.
So that means income can be one of the factors that determines the quantity demanded of a product. So it becomes a factor. Because it's a factor, it means as soon as income can either increase or decrease. So as soon as this happens, consumers would have to, readjust their spending or their consumption. Yes. So that is what brings about income elasticity. So let's go down and see. What is income elasticity of demand? One of the main factors that can change the demand for products is the amount of income consumers have to spend. So income elasticity of demand measures the responsiveness of demand to a change in income. So income elasticity of demand is the degree of responsiveness between the quantity demanded of a product as a result of a change in the level of income. So here they say we should consider two products, A and B. If income rises by 10% and demand for product A rises by 25%, the change in the demand is proportionately greater than the change in income. Economists will say that the product for product A is income elastic. So if the price of the product, if the demand for a product, if the income of a product, if the demand for a product rises above the level of income, then it is income elastic. That is the point they are making there. Do you get it? Mm-hmm. Do you get it or not, please? Yes. Okay. So economists will say that, okay, economy will say that demand for is income elastic. Demand for many goods and services is income elastic. Examples might include cars, fashion accessories, entertainment, holidays, and a wide range of luxury goods. In contrast, if the demand for product B only rose by 5%, economists will say that the demand for product B is income inelastic. This is because the percentage increase or change in demand is proportionately less than the percentage change in the level of income. So demand for some goods or services may be income inelastic. Examples are likely to be essential goods such as milk, food in general, and eating fuel. So if the level of income changes and the quantity demanded does not increase at the same level, then we will say the demand for the product is income inelastic. I think the point is clear there. Great. So that is about income elasticity. So we go to the calculation of income elasticity. The calculation is percentage change in quantity demanded over percentage change in the level of income, which is still the same. So we'll go to normal and inferior goods. Are you there?
Yes.
Okay. The value of income elasticity can show whether goods are normal goods or inferior goods. For normal goods, where an increase in income results in an increase in demand, the value of income elasticity will be positive. So for normal goods first, we call it normal goods because the quantity demanded increases as the level of income increases. And your YED calculation will give you a positive figure. That makes the good a normal good. I think the point is clear.
Yes.
Okay, so based on the calculation here, we have, product A and product B above are both normal goods because they are positive.
Yes.
But one is elastic and the other one is income inelastic. I think the point is clear there.
Yeah.
So for inferior goods, where, for example, an increase in income results in a decrease in demand, the value of income elasticity will be negative. So we call it inferior goods because as soon as the level of income increases, the quantity demanded reduces, which means it's going to give us a YED that is a negative value.
Yes.
So that makes it an inferior good. Is it clear?
Yes.
Any question about that? So go to the interpretation of numerical values of income elasticity of demand.